example, if you had $100 million and I only turned it into 105, even though you get the 5, I probably wouldn't take any of that because I only made 5 in 5 years. But if I get $100 and I'm managing it as a private equity firm in a fund, and I turned it into $200 million and there's $100 million of profit, then there'd be some split that could be 80-20. That's kind of a benchmark. And there, of course, there are adjustments and there are refinements. There's things like,
how different would it be if the same thing started looking now like it wouldn't change if nothing else really did? Subscribe and hit this like button and share this with a friend. Hey, this is Journey with Christian D. Evans podcast. This is Christian D. Evans coming at you. I thank you so much for listening to this. We interview top-level 8- and 9-figure entrepreneurs, business owners, and CEOs that have either had an exit or they are actually running and scaling their business to that billion-dollar valuation. We've also interviewed top-level TEDx speakers as well as incredible psychologists, also a lot of wealth managers that manage $1 billion to $200 billion and more. We've had incredible guests like Sachin Khajuria, Cameron Herold, Jay Abraham, and so many others. So if you find this of value, then share this with a friend. And we really appreciate it. Guys, show our guests some love by liking this and subscribing. And guys, until next time, remember, be uncommon if you can, and enjoy the episode. Cheers. Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, Christian D. Evans, as always. This next guest is the founder and chief investment officer at Achilles, a private investment business utilizing proprietary artificial intelligence technology. He's the author of 2 and 20, and we're going to be diving deep into his book and the foundation of the private equity world, which is really fun. It is a best-selling book about private equity and other private markets. Now, he is the limiting partner at other investment firms and multiple funds, including Apollo, which has north of $500 billion assets under management, Blackstone, which has north of $800 billion of assets under management, Carlyle, Silver Lake, and Goldman Sachs, very well-known private equity firms. He's been in the industry for 25 years with investment experience. Previously, he was a partner at Apollo, leading investments for the flagship global funds of private equity, distressed debt, and special situations across industries. Please welcome my next guest, the one and only Sachin Khajuria. How are you doing today, Sachin?
doing really well. It's a real pleasure to be with you, and I'm excited.
Well, Sachin, I really look forward to this conversation because, I mean, going from being a partner at Apollo with north of, managing $500 billion AUM, and then now writing this 2 and 20 during the pandemic, and now publishing it in 2022. And really what I found so interesting, I had the opportunity to read the whole book, and it's just remarkable, building that foundation, really simplifying the whole private equity world. But I want to start with this main question is, in the book, you talk about a really good analogy of building out really fixing a house, and you're relating it to how the private equity world works. If you could, maybe let's start with that so our audience understand what that looks like.
Sure. So private equity, in short, is buying or lending to an operating business or a business plan and seeking to improve it and then selling it, hopefully at a profit, after a number of years, usually 5, 7, maybe 10 years. It's as simple as that. You buy something, you hopefully buy it right, at the right price, in the right location, with the right maybe management team or support. Maybe you make some changes, maybe you need to upgrade the management team, maybe you need to make some acquisitions, maybe you need to trim some costs, maybe you need to improve the revenue. You need to do work, operating work to it alongside the folks who are running the business. And then at some point, maybe you take some dividends, maybe you refinance it, but at some point you're going to sell. That's it. So put like that, it seems pretty simple. And the right analogy, or an analogy I think that a lot of people can relate to who are not on Wall Street, but may have got involved in this kind of project for themselves, is buying a house, buying an apartment. And let's say you buy a house, an apartment, you check the area, you do your diligence, you hope you're paying the right price for it. Maybe you're aware that you're getting a bargain, or maybe you're aware you're paying a little bit more for something that's a bit of a safer bet. You keep it for a number of years, and then you sell it. Sounds pretty straightforward. And hopefully you sold it for more than you put in. Now, probably you took a mortgage to buy this property. So when you sell, assuming you've been paying your interest all along, or the interest has been building up, if the banks allow you to do that, you pay off the debt, and the equity that's left over is yours. In private equity, the same kind of thing applies. The difference is, of course, that it's mainly not your money, but you're managing other people's money. But let's put that to one side for a second. Now, if it was easy, anybody could do it. And what private equity does is take this sort of house example that I put forward, and it looks at slightly more complex angles. And let me tell you what I'm talking about here. What if the house had some kind of structural issue in the past? Foundations, maybe an extension was not done exactly correctly, or maybe there was a new subway station that people were expecting to come, but it didn't come, and it's delayed by a number of years. Or the house needs extensive work to refurbish. Or, for example, it's in an up-and-coming area that used to be more of a rundown area. Or maybe you're combining two houses into one. In other words, there's complexity of some sort, which is maybe a little beyond most folks. Some people could do it, but not everyone's going to be attracted to that complexity. Or it could be a large house that's being converted into apartments. Or it could be a number of apartments that's being put back together in a house. There's some complexity to it, right? If you add that complexity on top of what most people's house buying experience is, you're generally accepting this is a more difficult proposition, right? Because I'm taking different risks, maybe more risks. And when you're buying or lending to a company, those complexities add up generally. Now, what if in the same vein, you're not borrowing for your own account, but you're now borrowing, as I said, largely managing other people's money? You're going to be particularly careful with your own money. You better be at least as careful with everyone else's money. It's not yours. And you may put some of your money in the pot, but most of the cash is coming from pension funds, retirement systems, maybe high net worth individuals or families, maybe sovereign wealth funds. You're now providing a professional service, but you're still acting as an investor. You're their investor. You see what I mean? You are their eyes and ears. You are their guy. You are their individual who is making that transaction work. And so you're going to have to make sure from day one, because you know that the only way you're going to make a profit is at some stage of exit, most of the time, that you painted the right color. You put in the right Wi-Fi. You make sure that it appeals to as many people on the way out as possible. In other words, your exit universe of buyers is going to find it attractive. And maybe through the journey, the work that you're doing, the operating work, you are now making the asset, the house, the company, the whatever, as attractive as possible to that exit universe. And you're doing as much heavy lifting as you can in that time frame of owning the asset, that you really feel that you're doing all that you're capable of doing within a reasonable time frame. You don't want to keep it for 30 years probably, but you're within a reasonable time frame before you move it on. So it's a little bit like you're a developer in a way, a little bit, right? But of course, once you've done, if you go back to the house or the apartment, once you've done the sort of capital work, right? Like putting up the walls or changing the foundations, all those things, you're not actually then running the house while you own it. Do you see what I mean? You're not operating micro decisions day to day, hundreds of them, maybe thousands of them every month before you sell it. So the other part of private equity that you're going to add to that house analogy is the operating side, not just the capital side. When you put that all together and you're the right-hand woman or man to a management team that's running a company, you can see that it gets pretty complicated, right? It's not just capital decisions, it's operating decisions, it's financing decisions, it's capital structure decisions. In other words, it's active investment management. It's not passive. It's not buying the S&P when 2022 has been a terrible year and then hoping it goes up, just riding the wave. You're not riding a wave up after the market has crashed or at least has gone down 20-odd%. You're an active asset manager. And that's essentially what we all as investors pay for. We pay more in fees to active investment managers than we do to passive investment managers or people who are only doing a little bit of active work. But I think the example shows us that this is highly active investment management. The last thing I'd say, and I'm sure it's clear to everybody, is that I haven't mentioned the words computing, trading, quantitative. There's nothing automated about this. It's about people. It's about judgment of individual people. And so what you really get with private equity is the heavy lifting on improving a business, the operating of that business through the life you're living that business through. Before you sell it, you're obviously going to find the right way to buy it, the right way to sell it, the right people to sell it to. You're going to do all that work, maybe with your advisors, bankers, lawyers, and so on. But also, it's a people-driven activity, and it's highly active investing. Does that make sense as a kind of summary of really what we're talking about?
Oh, it definitely does. And that's why I really appreciate building that foundation, because I think it helps people understand, because I see in the investment banking world, if you're not from that, technical babble and understand all the technical lingo, then it's really hard to understand. I love how you just simplified it in the book, because it was able to oh, that makes sense. And you're able to say, this is what private equity, you think about buying a house, and everybody has some sort of connotation or some sort of metaphor with the buying a house, because many of us have increased our houses, whatever. Now, I want to ask a little bit about, Sachin, you wrote this book during the COVID situation, and I think that was really cool, optimal time of use of your time. Where was the motivation? What was your inspiration? I mean, coming from a partner at Apollo to then be able to say, you know what, I want to give back and share this ecosystem that a very few people actually are very familiar with or taking advantage of this alternative investing strategy. Where did that motivation come from?
Well, it's a great question. I'm grateful you asked it too. It's a few things. I think number one, you do this kind of project, as you said, to give something, to try to help folks understand. Buying a book, as I tell the kids, is one of the most cost-effective ways to get a bit of an education in a topic if it's a well-written book, and I've tried to make it really accessible to everyone. There's a big glossary at the back of lots of terms, as if I was talking to a friend at a bar or just at home having a chat. And it's really about helping everybody understand what this business is about and how pervasive and how enormous it is. So it's not just wanting to tell everyone about some tiny niche somewhere. This is a $12 trillion industry, $12 trillion in assets under management, in commitments. And I think through the next decade, particularly as private markets are probably doing better than public markets, right, at the moment, you're probably going to see this industry grow further, I think, through $20 trillion. And it's everywhere. It's your employer. It could be the kindergarten that your kids go to school at. Could be the dating app you use. Could be your grocery, your grocers around the corner. It could be your the retail outlets you go to. It could be the movie theaters. It could be the folks who provide the military services that guide the missiles that keep you safe. It could be so many parts of the economy: energy, chemicals, telecom, media, the cable TV company, whatever. So private equity owns lots of shares of lots of parts of the economy, chunks of the economy everywhere. And I think, stepping back as someone who's an insider, I figured not everyone really thinks about this. They think about big public companies. They think about Apple, Amazon, Microsoft. Through COVID, I realized everyone's now thinking about pharma companies as well. You know who Pfizer is, you know about maybe AstraZeneca, you know about some of the other folks as well, Moderna. And you sort of start to think about big pharma, not just big oil or just big banks or big IT, big tech. And this is big finance in another way. And so it's really trying to bring awareness of something that is already everywhere. In other words, I figured that this is not something, Christian, which is on Wall Street. This is a Main Street topic. When you get to these kinds of numbers, 12 trillion heading, I think, towards 20 trillion, this is a mainstream topic. And the reason that most people don't look at it is they pretty much outsource this decision. If you have a public pension, if you're a teacher, you're a firefighter or something, or a policeman, policewoman, your pension is probably investing in private equity or private markets and you don't know it. And because increasingly the choice of these funds is coming to retail investors over time, I wanted everyone to be aware of it before they have to make a decision whether it makes sense for them. Second point, so many college friends, school friends, family friends, they started dabbling in this industry one way or another, that asked me all these questions. Unfortunately, they typically ask me if it was a good idea after they've committed the investment. And they'd say, well, I met my stockbroker or my wealth manager, or I don't have any of those things. I did a bit of research and I went to one of these fund aggregator platforms and I put $50,000 in this private equity fund. That was a good idea, right? And I was like, have you done it? It's like, yeah. It's like, which firm? I was like, I have no idea who they are. Like, did you do any homework? He's like, no. It was like, but you're a doctor. You do so much homework when you're doing that operation, or you're a clinician, or you're a teacher. You're pretty careful when you're marking the kids' homework. But now it's your hard-earned savings and you've just kind of just given it away. Like, how does that make any sense? And so I'd say these two things, if so trying to get something back, and also trying to educate people on where they should be sort of putting their dollars to work, and taking the time and the care to educate themselves over these questions. This was an enormous part of my motivation. And I thought the most democratic way to do it, given we're seeing the democratization of finance, the most democratic way is you just write a book, and it's available on audio, on print, on the Kindle version, digital version. It's a very accessible, democratic way. You're not just teaching a course at a business school, which is only for an elite few. You're doing something that's accessible to everybody. Does that make sense?
It does. And what's so fun about this, and I just want to share to our audience a little bit about where the industry is going and what you were mentioning here. I know private markets, they used to stay private, these companies, and then IPO for like 6 or 7 years, and they would IPO at some point. That is elongated to now almost 11 to 14 years on average. And then also we're seeing, because I think what's happening, I was talking to someone, the institutional investors are realizing that they could increase, their rate of return by keeping them private a little longer, which then obviously, helps the bottom line. And my question, and also what I'm noticing with the Jobs Act, as well as some of the SEC guidelines, they're readjusting, which of course, increases more capital. So a lot more individuals are having access to this, which is really, really good. Now, I know with wealth managers, we tend to normally, you hear the 60-40 split of some sort on average, right? For a lot of people's, investment thesis and whatever, where, stocks or bonds, or, depending upon obviously your age, your race, your, kind of, longevity, et cetera, et cetera. But now what I'm noticing is a lot of wealth managers are adding some sort of private equity. They're deploying some capital in this at that higher level. And you mentioned, 12 trillion to 20 trillion. Sachin, overall, holistically, with some of the data points I just mentioned, what are you seeing in a good way, like democratizing this vehicle that is, of course, better? And I think there has been a lot of stats that private versus public companies, private is outpacing public companies currently. So I would love for you to just share your thoughts on that.
So first of all, you have to check whether you are an investor in private markets already. It's worth just doing that double take and looking up your pension plan and seeing if your pension provider, if you have a corporate pension plan, for example, if you're a public servant and you may have money in a retirement system, a public retirement system. If they are investing in private markets already, you need to add that to the pie chart that you're probably not thinking about. So when you're doing your 60-40 split, or whatever your split happens to be, not only should you include your real estate, if you have real estate, and your savings, your cash, if you have cash, but also whether, if your pension provider is already doing it, because that'll give you a more accurate figure, right? It's not just what you're controlling and running, it's also what people are running on your behalf too. And so what I'm seeing is, at some point, you ask yourself, am I being adequately compensated for the risks I'm taking in my current split? Do I feel good in the last 2, 3, not just 1 year, 2, 3, 4, 5+ years about the risks I'm taking? And do I think I can tie up some capital that's illiquid? Really important you understand that you can't just take it out. And so, with stocks, they can be terrible, they can have a terrible year, but if you urgently need it, even if you're going to sell at a loss, you could probably sell it pretty quick and get your money out, right? And so with this, you typically cannot do that. And so you have to ask yourself, do I have any money that can be tied up anymore? And I want to tie it up for, let's say, 10 years is probably the minimum horizon I personally would think about. And if I do, how much is it? Let me then reverse engineer into what my percentage is. And you probably find it's somewhere between, I'd say, 10% of your pie chart to 20, 25% that you feel you can tie up over time. And again, that's going to change. If you are later in your career, your life cycle, whatever, and you are not working and maybe, you have a different perspective, or whether you're younger and you're earning, maybe you could be a higher earner because you're more active in your younger years and you feel you can tie up for longer. I mean, all these things are going to impact, your decision. But rather than 60-40, I'm seeing more like being carved out of that 60-40, 10 to 25%, maybe 30% of, let me put a bit into an alternative bucket. It's an illiquid bucket, right? That's what I'm saying. And then, of course, the question is which fund, which platform, which product. Is it credit? Is it debt? Is it infrastructure? Is it private equity? Is it all of the above? That's what I'm saying. And I think that this, it's not like 60-40 is dead, but I just think it's been updated a bit as private markets are no longer a niche product for only institutional investors above an enormous size, like tens of millions of dollars, to increasingly coming through aggregator platforms, retail platforms. We're just revising that 60-40 to look a little bit more like I said. That's kind of my current thinking on that.
Yeah, and that's why it's so interesting to see this, and that's why it's so fun, because I understand. I pulled up something here, McKinsey's private market and the alternative, investing, and they got a graph from basically 2008 to 2021, and infrastructure, natural resources, real estate, private debt, and private equity. And private equity, their range is 10.5% IRR, internal rate of return, to 30.5% IRR during that time frame. And that shows to me that outpaces private debt, real estate, natural resources, infrastructure almost 2 to 1. And that right there just shows to me like that vehicle itself, and a lot of people don't have access to that vehicle. And you're seeing through all these other organizations, endowments, pension plans, all these things, they are deploying some capital toward this vehicle, which is increasing people's wealth and outpacing the public markets. Is that correct? Am I reading that correct, Sachin? And what's happening?
Yeah, pretty much. I think those institutions have always given to private markets. In particular, private equity is probably the largest and most famous. Although right now, with banks pulling back and lending, private credit has become enormous. But let's just say private markets in general. But I think those folks are increasing their allocations because, if you put your money in the S&P one year, you might make 25%. The next year, you might lose 20% or some variation of the above. And so you can't really rely on that if you're a pension fund to provide a target return pretty much every year. If you need to provide, let's say, I'm going to make this number up, 8% every year as a pension fund, if that's what you need to be earning to be able to meet all of your obligations, to make all your payouts, to send out all those checks every month, right? If you need to make 8% every year, pretty much you're very sure that you'll make that 8%, then you're going to have to mix it up beyond using just public markets. And I think the thing to think about, and if I may highlight, is even in that range you quoted from your McKinsey report, 10 to 30%, that's an enormous range. And what the book really is about is how come some folks are at 10 and some folks are towards the 30? What are the traits that are driving success that I've seen for the folks who continually do better? It doesn't mean the rest are not doing well, but what's really charging the best ones in the industry versus the ones who either cannot beat the public market or they're just barely beating the public market. And that's really what 2 and 20 is about, is kind of isolating all those traits and saying, when you're doing your own homework, you're looking at funds to invest in, or even if you're a wealth manager, you're trying to educate yourself more on what you're going to offer your clients. What are some of the traits that you should be looking for in the people that are running these funds? Because as I've said before, it's a people business. And, all of these firms, Christian, have smart, honest, good people. Like, they all went to great universities. You find they have MBAs, or they're at Harvard or Stanford or great colleges around the country or even the world. It's not like one firm has all the monopoly on good people and everybody else doesn't, works everywhere else. That's not the case. The case is that they're all pretty smart everywhere, but some of them have certain traits that make them more likely to succeed. And that's what I've seen in the last 25 years and how I make my own decisions. And I'm not selling services as an asset manager. I just, I manage my capital. I'm not selling that to somebody else. I'm telling you flat, here's what I've seen as successful. And that's what I'm trying to summarize in the book with a lot of stories to illustrate those traits and principles.
Yeah, and it's interesting because, see, even in the private equity world, each one has their own investment, kind of business structure as well as their thesis, right? They focus on a specific industry, whether it's through a funds of funds approach or whether it's a roll-up structure or whatever it is. And I want to ask you a little bit further, Sachin, because you do, and I'm glad you kind of brought this up here in regards to the characteristics, the traits, because for someone that's, now that you brought that foundation of what private equity is and how that obviously it increases, and we just kind of touched on obviously the outpacing of the public markets. Now it's really identifying, okay, what are the green flags and the red flags? What should you be looking for? And obviously a lot of individuals, they look at like Apollo and BlackRock and Carlyle, very well known, well established, got tons of experience as well as, back end experience, and saying, hey, these are our results. And so it's the likeliness of them producing that kind of result in the future is much more. So help us understand, unpacking that, what do you see in regards to the people, the qualifications, the operations, and saying, hey, you know what? I feel comfortable writing that 50K check instead of saying, oh, shoot, So help us understand a little bit, Sachin.
Yeah, look, I'll give you a bit of a preview of what's in the book that goes through this in a lot more detail. But the first one is you have to think like a principal, not an advisor. So let's unpack that. You're not a banker. You're not a consultant. Even though most of the money being invested is other people's money, you do have some skin in the game. You do have some capital, but you have your entire mind, body, soul, work ethic working on that deal. You are thinking as a principal, as the investor, as the owner, not an advisor. And that means if you make a mistake, it's your mistake. You don't just walk away and say, oh, that was a terrible deal. You're not a public company executive who could get fired for making a mistake, and then the new guy comes in or she comes in or he comes in or whatever, and you just, they try to fix the last regime's mistakes and all that stuff. You're supposed to make it, but you're supposed to work through your problems and get back to return the capital that investors have given you. So it's a return of capital, and then you make a return on capital at some point. And so this is the number one thing you need to see. And you need to look, you see it in the eyes, you see it straight away. These folks, they're on it. They're living this deal. Because remember, we're talking about 5, 7, 10-year timeframes for deals. So each investment is not just a significant part of your job. It's a significant part of your life. You're living this investment, right? So this is number one. And this is something you have to discern as a people skill, as a sort of a real litmus test of, do I really feel that they own it? Or, to them, it's like, if it doesn't work out, they'll just move to the next deal, right? Number one. Number two, there has to be a financial alignment that backs up that incentive. And the best alignment, why the book is called 2 and 20, is if you only really make money when your investors make money. Call it success-based, but it's the ultimate version of success-based, which is, if you as the investor, Christian, don't make any profit on this deal, I make nothing. I'll probably make a fee for managing your money. And you might say, well, that's, why is that? I'll say, well, I'm going to keep the lights on. I'm going to pay the salaries. These are highly paid, smart people. But of course, if I keep doing that for a while, no one's going to give me any more capital. My business is going to be over. So it's not like that's a long-term strategy, which is forget the return and just make the management fee. It's like, I've never seen that as a deliberate strategy in private equity or any business in private markets, actually. And so you have to have an alignment where the vast majority of your compensation, you got to wait until your investors make money. So if it takes you 10 years to double the money on a deal and get out of that deal and pay the investors their share, it should take you 10 years as well before you make anything on it. And so you're aligned, right? you have a financial alignment that matches the principal, which is you think like a principal, not an advisor. The third one I'll preview, and I'll leave it there because I do want to make sure that people have enough left over to actually want to read the 14, 15 chapters in the book, is temperament. And you might be surprised I said that, but it's probably the most overlooked trait in private markets. This is not a trading floor. You're not throwing staplers across the floor. You're not looking for that juicy bit of information to trade on. It's not like one of those, Netflix series like, Billions or Succession or one of these things where there's like, quick action, day to day. No, this is long-term investing, long-term, active, data-driven, library of data. We talk about it in the book, driven, intelligence-driven, network of contacts-driven investing. And for that, you have to have a very long-term diplomatic, statesman's-like, in a way, temperament. And it's hard. I got it wrong plenty of times in my career. Even the most successful people I worked with or worked for got it wrong all the time because we're human, not robots. And so managing that intensity, right? That focus of thinking that it's your money, it's all on you, right? You and the team, of course. When I say you, I mean you as an individual, your deal team, the management team, everyone working together. Managing that intensity with the temperament of a long-term transaction and all the relationships and network you need for that, that's hard. And so these three things I think are just, non-negotiable. You absolutely have to see that in the managers you're picking. And beyond that, there's probably another, 10, 12 things that, we go through in the book that really you should, when you're doing your diligence, you should really be looking at. And that's why we've had the response we've had from, everyone from pension funds to regulators, people saying, I really want to understand what it's like behind the curtain and what makes a successful private equity firm successful in detail behind the curtain, as opposed to the ones that kind of just do okay.
So I just want to clarify something here, and I appreciate kind of unpacking that. You do go a lot more further into detail on the book itself, but regarding the 2 and 20 structure, and I think I was very confused when I first started, and then allowed me to understand a little bit about, okay, this is, and you clarified this a little bit in the book as well, of course, but the 2 and 20 structure, for those that don't understand, it's like, okay, you want to raise $25 million to acquire this company, just keep math easy. Within 10 years, you scale to 100 million. That's 75 million gross, right? Top line, up to the right. That's 75 million, 80-20 split, right? 80% back to your LPs and GPs, your investors, and then 20% back to the firm, with the 2% every year managed. Is that correct on how I'm?
Yeah, broadly. I mean, you'd have 2% of the assets under management. So obviously, if your assets are going up or down under management, that 2% will result in more or less in fees. And there are lots of variations. I mean, some funds are 1.5 and 15, some are 1 and 10, some are even more than 2 and 20. But 2 and 20 is seen as like the industry benchmark, right? And what's key about what I just said is that if you're not making, if there's no 75 in your example, then the 20% is zero. And what you also typically have is what's called a hurdle rate, which is that, let's say you only made $1 above your money you made in. I don't get 20 cents of that. I need to make a minimum return for me to make anything. That's typically called a hurdle rate. And that hurdle rate is usually set somewhere around 8%, although it varies strategy by strategy. And so, for example, if you had $100 million and I only turned it into 105, even though you get the 5, I probably wouldn't take any of that because I only made 5 in 5 years. But if I get $100 and I'm managing it as a private equity firm in a fund, and I turned it into $200 million and there's $100 million of profit, then there'd be some split that could be 80-20. That's kind of a benchmark. And there, of course, there are adjustments and there are refinements. There's things like, deal fees, transaction costs. There's lots of, things around. But in general, this is pretty much the principle, which is, you're looking to make a significant cut of the profits of the successful deal because you made it happen. And of course, let's contrast that again to either an active liquid strategy like a mutual fund. A mutual fund might charge you 1% management fees or maybe 2%, depends on the fund. But they typically don't take a cut of the profits. A very passive fund like an ETF, like an exchange traded fund that just buys off the FOP, you can get it from BlackRock or iShares or Vanguard or somebody. They're probably only charging you 10, 20, 30 basis points, maybe 50 basis points. So they're not even charging you 2%, they're charging you a fraction of 2% to manage their capital. But it's passive. And you just, you're hoping you timed and ride that wave correctly. So, there's a place in your portfolio for all of these things, I believe, personally. My personal view is you should look at all of these strategies, but you've got to decide, am I doing it with my eyes open? Am I taking the active decision to have 10% here, 20% there? Am I working with somebody to help me get there? Because otherwise you're working so hard every day, particularly in these extremely tough conditions we've been facing. And then what? Your financial future, you're just going to roll the dice, or you're just going to assume that I got a bit here, a bit there, but I've never really paid attention to it. I mean, it's a skill. It's a skill you need to know. You know how to drive a car, probably. You need to know how to manage your portfolio at least the highest level, right? You need to know, I've got this much in public markets. It's liquid. I can take that out. It's with this manager. I'm paying this. I got this much in private markets. I only got this much because it's tied up. I'm paying this. Look at their track record. These are simple questions everyone should know. And that's really the purpose of the book, which is to make sure as many people as possible have a no-nonsense understanding of this from someone who isn't trying to sell them anything really other than, logging on to Amazon or something and buying a copy.
Yeah, and I definitely highly recommend for anyone that's listening that they do need to go ahead and read this, because it is, even though this private equity world has been around for a little minute now, in relative respect to obviously all the other alternative investing strategies, this one is relatively newer, right? Even though it's been around since, I think, BlackRock exploded, back in the 80s or so, and I think that was one of the best, one of the bigger ones. But my point is now we're seeing it more accessible to everybody, right? Where everybody has access to it, and that's why I get so excited about it. I want to talk a little bit about. And I know that you don't discuss this in the book, but I do want to get your opinion on this: how blockchain and the tokenization is going to revolutionize this. I've seen this a little bit in the real estate industry, where some of these minority groups, right, may not be able to take a loan out to be able to buy a property in real estate. But what they can do is buy a portion of the tokenization or portion of that piece of property. And I love how they, I was looking at one platform, and I think it's the same structure with private equity, where they're able to democratize this, give this offered out. And see, I do know crowdsourcing for a lot of startups, but that's in the VC world. And you and I know the VC, it's just, basically, it's like a hellhole sometimes. It's you never know. But the thing is, private equity, you're working with companies that already have proof of concept, go-to-market strategy. They've already got things rocking and rolling, right? So the likeliness of them growing is higher compared to the VC, right? So my question is, Sachin, what do you see with blockchain technology, with tokenization, how that's going to revolutionize this industry as well and democratize it?
So it's a great question. I think that few levels to the answer. First, at the level of the private equity firm and the industry, I think this sort of blockchain technology is going to improve aspects of it, whether it is the way data or information is transmitted. It's about security. It's going to have its place, but I don't think it's going to be a single driving force. Why? Because ultimately, what makes these deals successful or fail is the judgment of people, and that cannot really be automated or kind of packaged. You know what I mean? You can't really package it. The way to democratize this is really to make the checks accessible to as many people as possible. Now, could you have a strategy which is funded by Bitcoin or something else. I'm sure they're looking into those things. But I think given the people-based nature of this and the fact that where a lot of the magic comes from is buying well, selling well, and most important, the heavy operating work that's done in between, that's something which is, not directly applicable in the format you're saying at the moment. Now, when you then go to the level of individual portfolio companies, depending on which field they're in, you could find that this is more relevant for how they're running their business, managing their business, and so on. But I mean, I don't see a deal funded by, a virtual currency at some point, so, a cryptocurrency in the near future. I've seen many bidders try it. In fact, there's a very famous example recently of a large transaction that a bidder came out of I can't name names, but came out of nowhere with a very compelling bid until they said, oh, by the way, it's all in Bitcoin. And so, remember that if you're buying from a private equity fund, so to speak, they really want to give cash back to the investors. Because if you're giving cash back to your pension fund, that's what they need, right? It's not a paper gain, it's not a hedge fund. It's cash in, cash out. If you then went to the university or the pension fund or retirement system and said, listen, we made this fantastic return, we're going to pay back in Bitcoin, that's probably a violation of lots of parts of the agreement of how much cash they're putting in, what they're getting out. So I think it's getting into the sector, but it's not an immediate driving force. Where it is more relevant, I think, is individual companies right now. And the way this is going to become more democratic is education, opening up products which are suitable for retail investors. And that's slow, but it's coming. And in the meantime, a lot of these aggregator platforms that are hoovering up these checks, which are smaller than the multi-million-dollar checks you used to need. And then those aggregator platforms, could be a private bank or it could be somebody else as a wealth managing unit, then provides a single check to the private equity firm to say, we've raised this much money from you from smaller checks. So you have this sort of retail channel going. Does that make sense?
It does. Let me ask you and you mentioned this on the retail side, wealth managers, RIAs, those kind of, individuals that are dealing with the clients. What would you say on the level of education they are at in the private equity world? Because I know this is more of an investment banking, Wall Street kind of instrument a little bit. But I do know, obviously, they're very familiar with stocks and bonds, wealth managers and RIAs. So where would you say, and get just like a heartbeat, would it be individuals like my audience that would have to go to their wealth manager and say, hey, I want to reallocate some of this toward, private equity or, alternative investing? Or would the wealth manager already have that, kind of that knowledge a little bit? Just so I know, like, what are you seeing in the industry? Is it very knowledgeable?
I think it's improving, but just how not many folks have actually worked in the industry, and that's typically how you can spread knowledge. Is I used to work there and now I do this, or I know somebody who works there and they told me about this. I think that knowledge base is emerging because previously this was really the preserve of professional or institutional investors. And so you didn't need all of those retirement advisors, wealth advisors out there knowing about this. But I think that's changing. And so I think, it'll take a minute for us to get to where we should be. The first question anyone should be asking is not, I want to reallocate, is I want to learn. I want to know about this. What is this relevant for me? I want to learn about this. And I want to see how I can benefit from something that was previously reserved to a different corner of the market, larger checks, very wealthy clients. And now it's, coming to other pockets of the market. First, before I make any decisions, I want to allocate. Before I dive into anything, I just want to learn. And if the answer to whomever you're talking to is, oh, I can't teach you, well, then you're talking to the wrong person. And then you need to find, need to find the right person to teach you, because that's the very, very first step, is to kind of figure out, going back to our house analogy, you live in New York and you're thinking of buying in DC or Boston, and you wouldn't just dive in. The first thing is just like, let me figure out the area. Let me learn about it a bit. Let me see what's going on. Let me speak to some experts. Let me travel it. Let me case it up and down. Let me visit the streets. Let me do my due diligence before I put money in. And so I think that the community you're talking about is incredibly important in terms of distribution and knowledge, but I think it's going to take a minute for everyone to get there.
Okay, I was just curious because I was talking to a wealth manager and their firm managed about $1 billion. And I asked him, do they put any toward alternative investing? He says, no, not really, because I'm not too familiar with that industry. So that's why I was just curious, like what have you seen on the heartbeat of that industry? Like how familiar are, and I appreciate you just sharing that. Like there's still room for improvement for that education.
And that massive room. In fact, a lot of the private talks we've done, corporate talks, private podcasts we've done through the publisher Penguin Random House or myself, they have come from wealth management businesses that are saying, we now have access to these products. We're about to sell them to all our clients. We better make sure we know about them first. Can we come talk to you? And we're going to speak to some university professors to get a technical angle. We're going to speak to some industry leaders, but we want to sort of realpolitik behind the curtain view. We want to come talk to you, understand this before we go off trying to sell this to other people. And I think that's smart to get as many opinions of hopefully relevance as possible. But I think we are not there yet where I could tell you, okay, Christian, you want to know more about this, speak to that particular wealth advisor who I know they really know this field. Do you know what I mean? And it's just as a history. It's just because it was not accessible to lots of people and now it's becoming accessible. The education will catch up. And I think actually where we need to be is the education has to be ahead of the decision, right? And so that's hopefully the direction we're going in.
Sachin, I really appreciate Sachin, I appreciate you being on the forefront and talking about this and leading the charge on this, because I think it's just revolutionary to see how you are bringing awareness to this that needs to be, brought aware, right? And, for those that are, realizing that you can make a lot of growth and a lot of preservation and wealth, but you have to be in the right vehicle. And this is, something that very few people are very familiar with. And having, like you mentioned, the education, but people like yourself that have been in it, that know the ups and downs, the red flags, the green flags. I want to ask you real quick about your career with Apollo. I think there are certain times where, our failure is our best learning experience, right? And then we can analyze that failure and those experiences. And Sachin, if you look at the 25 years, and I know there's probably certain experiences that happened that you had to learn from. And I just want you to think about that young Sachin and say, okay, what did you learn? What were those pivotal moments? And what were those things that you learn now that you apply into your family office, into your investment thesis now, and the way you think about things? If you could, I'd just love to share your thoughts on maybe a few of those things that you learned throughout your journey, man.
I'd love to. It's a lovely question. I'm flattered you ask. I mean, most of it's in the book because a lot of the lessons that I've seen that I've kept are lessons that I've seen work through that sort of 20, 25-year period in private equity, not just, they weren't written for the book. They were things that I think are real principles that I then distilled into the book. But there's stuff beyond what we've talked about. So let's talk about that for a second. I think number one, some of the most important learning experiences for me started when we were working on a deal and we just had a blank sheet of paper. And it was like, okay, let's draw the mind map. How do we make money on this deal? How does money come into this business? How does this business turn money into, money that has longevity? In other words, a repeatable, sustainable cash cow. How do we sell this business? How do we exit this business? And it was really blue sky thinking and not just taking a template. Don't rely on a template. It was, okay, we're doing something new. It was, for example, when we first looked at insurance, or first looked at pharma, or first looked at lots of other sectors that, we had never done before. And this is not particular to any specific firm I worked at, but anywhere, any point in my career. Or we looked at geographies that we thought were just very tough to invest in. What's the plan? And so that brainstorming, as I sort of call it, like, the white sheet of paper, just no templates, just starting from scratch, first principles thinking. It's actually not slow. It's incredibly fast, because when you have first principles kind of thinking, you have to only write the key points, right? This is how we're going to do it. This is what we believe in. And what that also does is it highlights the assumptions you're making in your analysis for success. It highlights the assumptions you're making before you get to what you think good looks like. So I think that's been absolutely critical on almost any transaction, where, if somebody asks you about it, you're not digging out a memo and trying to pull up a file and you got it, because you've reanalyzed it from first principles. This makes sense because of this. And you probably find that rather than looking at thousands of numbers, there's a dozen key numbers at most that you need to actually know, like individual numbers. And those are the absolute key numbers that determine whether that deal is successful, that investment will be a good investment or not. So I think it's number one. I think number two, it's so important to spend an enormous amount of time building relationships at every single level when you're doing these deals, or in general, when you're working through your portfolio as an investor or you're a business person. Because most of the interactions that I had were impactful. The vast majority of them were not at the C level alone. They involved the C-suite all the time, the chairman as well, the board, etc. Often I was a board member or even the chairman of certain companies. It's the layer below that, below that, below that. Influence the guy who influences the influencer. Influence the next level and the next level. Start the chain reaction. Have everyone say, we get this. Not everyone just say yes. You don't want that. But everyone buy into the debate, right? The third thing I learned is the best people I worked for and the best people I worked with were the ones who did not want everyone around them to just agree. We're doing this because of this. The rare example where I saw a deal fail is when someone would just say, oh, no, we're doing this. We're doing this because, I've made money in the past and I know what I'm doing. The very few times I heard that, every single time, it ended up being a very troubled investment. Every single time, right? And it very rare. But when it happened, it's almost like I'd hear it, I'd be like, oh no, not again. I remember that 3 years ago when the other guy said that, and lo and behold, 18 months later, it went south and took a long time to fix it if it was fixable. And so, relishing that respectful, robust, data-driven, high conviction debate, and if you don't have a conviction, at least pertinent question debate, that is absolutely key. And of course, we could apply that to so many things, right, Christian? You could look at your own business and say, I really would like to know the 3 things that everyone thinks that I think I'm doing wrong or not well enough. It doesn't matter what it is. It can be anything. It's probably not, they don't like my shirt or my headset or something. It's probably something more substantial they don't want to say, right? And the nice thing about private equity and more generally private markets is that people are not shy to voice their views. And that stimulation, that debate was just unbelievable. And that's what really creates culture, these sorts of factors. There's plenty more, but these sorts of transparency, robust debate, blue sky thinking, not looking at templates, being really clear, starting from first principles, all of these things, building relationships at multiple levels, because that also builds ideas. This is what you find in the best sort of firms. And you find that it's a culture. And, it's such an overused word, culture, but it's culture as in, it's the stuff you see every day. It's not that one home run they're doing every 5-10 years that saves the fund. You see this kind of attitude of ownership, of alignment, of all of it every day. And when I've seen that in funds that I've worked at, that makes me think, okay, if and I don't want to work there anymore, I want to do my own thing. But I want to give them capital because I know that's how they work. And they're going to be good custodians of my family's capital. Does that make sense?
It does. And that's an old adage of, iron sharpens iron, right? You don't want all, head nods. You want individuals that come against you a little bit in the proper way, having that right synergy and having the right relationships, but at the end of the day, for the larger mission of the goal. And I appreciate you kind of, sharing that. And, that's just a good reminder for everybody. Sachin, again, I really appreciate you being on here and sharing 2 and 20 and unpacking this and the private equity world and just a lack of education. But what's so fun is people like yourself educating so many so that we can obviously take advantage of this alternative investing vehicle, this vehicle that is producing consistently at a very high level. And you go into a lot of detail on this. Sachin, for those that want to reach out to be part of, get your book, as well as get access to maybe connect with you or listen to all your other podcasts and other, you've been on Bloomberg and CNBC and all sorts of fun stuff. How do they reach out to you and be part of what you got going on, Sachin?
Sure. So the family office has a website, achilleslp.com. There's a contact page. Everyone, all of your community is, welcome to sort of put a message on that contact page and send me a message. It'll come to me, reasonably soon, and I'll be very happy to reply to anybody. And we've had, I would say, honestly, thousands of messages on platforms like LinkedIn and other social media platforms where people have said, could you come and do a talk at my company? Could you do this? Could you do that? For us, we're not looking to make money off speaking or look at new revenue streams. It's about, well, if you bought the book and you've read it and you want to debate it, discuss it, go beyond it, that's absolutely fine. And for us, that me and the publisher, when I say us, it really is about education, and that's why this is not, as I said, a business school course. It's been done as a book for everybody. But the other thing I would really encourage people to do, I didn't listen to enough podcasts before I started to go on them, being honest. And I didn't listen to enough audiobooks before Penguin Random House got an incredible voice actor to do the audiobook. And so I would highly recommend for folks who read the book and like the book to also listen to the audiobook, because it's a little bit different when you've got a voice actor going through it. And he's much better than I ever would have been in sort of narrating and going through the book. He's an outstanding individual who does it. So I would recommend people do that. Please do send me a message on the Achilles LP website if you would like to. And aside from that, I'm sure if there's an opportunity, Christian, we'll be back with you at some point in the next year or so and continue to talk more.
100%. And guys, those links are in the description below. I'll put the Amazon so you can click on that and buy it there. You can also get it on Audible. You can also get it LinkedIn. I'll put his LinkedIn as well as his website down there. So make sure you just communicate with what he's got going on. I would highly recommend it. In fact, buy the book for yourself and then buy it for your wealth manager as well, so that everybody gets educated on this, and for your family and friends as well. Again, Sachin, I really appreciate you being on here and being on the forefront. And again, I had the opportunity to listen to audiobook, and very, very impressive stuff. I always like to ask my guests before I let you go fully, is there any last words of wisdom they'd like to share with our audience?
Last words of wisdom. So it looks like it's gonna be a tough year, and I would just keep it real simple. Keep it simple in doing the things you really enjoy, cutting out the stuff you don't really need. Keep it simple in your portfolio, sell those assets that aren't really doing anything for you, and keep it simple in just having fun, staying healthy, being fit. I've certainly started the year off that way, and I hope people can do that. People sometimes ask me, what am I reading? If that's of relevance, I'm actually reading, in addition to books that everybody seems to be reading, like Atomic Habits, I'm reading a fair amount of Jordan Peterson these days. And so for folks who like that kind of thing of psychology and that sort of wisdom, I do that. So I hope there's some useful points for your audience.
Well said. Keep it super simple, as well as Jordan Peterson. That's awesome. Guys, that is the author of 2 and 20, as well as Chief Investment Officer at Achilles, my friend, Sachin Khajuria. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can. Yo, this is Christian D. Evans, Journey with Christian D. Evans podcast. We thank you so much for listening to this amazing episode. If you feel and you know that this was valuable to you, please show some love to our amazing guest by liking this, by commenting on this, by making sure that you do a nice 5-star review and just show some love to our guest. That'd be really awesome. Also, make sure you share this with a friend, a family, a colleague, someone that you believe would bring value to their life right now. And guys, we just want to say thank you again for just being part of our community. If you want to have more resources, don't be afraid. Go to christiandeevans.com. You can actually schedule a phone call with me, or you can send me an email at christian.evans@beUncommonIfYouCan.com. That's christian.evans@beUncommonIfYouCan.com. Always love to hear some feedback and let me know what is the number 1 or 2 things that you are struggling in your business and your life, and we'll make sure we have those conversations. Guys, that is Journey with Christian D. Evans podcast, and until next time, remember, be uncommon if you can. Cheers.